Welcome to another FAR walkthrough video. I'm Logan, and in today's video we're going to be going over preparing a statement of financial position. And we're going to be doing that the Superfast CPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, make sure you go to superfastcpa.com and check out our free 1-hour webinar training. We go over the key ingredients to passing the CPA exam, and again, it's only 1 hour, it's free, and we will show you how to pass the CPA exam without wasting months or even years of your time. The link will be in the description, so make sure you go check that out. Also, just letting you know, we will only be going over 6 questions in today's video, whereas Superfast CPA members will have access to the full 12-question video when we post it in the members forum. So, if you like this, you can get more of it by becoming a Superfast CPA member. With all that said, let's dive straight into the questions. Alright, here we are at question 1. A not-for-profit entity received the following donations during the fiscal year. Which of the following donations should be classified as without donor restrictions on the statement of financial position? Okay, so we talked a little bit about this in the previous video where we were talking about the purpose of the statement of financial position, but in this video we're talking about, actually preparing it. So which of the following donations should have been classified as without donor restrictions? So again, we kind of talked about this. If you watch the previous video, you'll know kind of what we're talking about, but if not, that's okay. We're going to dive straight into the answer if you don't know how to do this. Alright, the answer is D, a $200,000 cash donation intended for general operational support. Okay, so let's walk through this. This is going to kind of give us a background about with or without donor restrictions. In preparing the statement of financial position for a non-governmental, not-for-profit entity, donations are classified into 2 categories, with donor restrictions and without donor restrictions. So we're going to talk about both of them. So for with donor restrictions, donations fall into this category when the donor imposes specific conditions on how or when the funds can be used. Examples include funds restricted for a particular purpose, like building a new facility, funds that cannot be used until a future date, so that's a time restriction, or endowments where the principal is to be maintained in perpetuity and only the earnings may be used for specific purposes. Okay, so those are some examples of with donor restriction, and just a heads up, almost this whole video is going to be us talking about with donor restriction and without donor restriction. We're going to be talking a lot about the net assets, because assets and liabilities aren't too different for a statement of financial position for a nonprofit entity compared to a for-profit entity. Their assets and their liabilities on the balance sheet, not too different. But when it comes to the equity or the net assets, in this case for the not-for-profit entity, that's where it gets a little bit more complicated or a little bit more confusing. So we're going to focus mainly on the net assets. So let's go to without donor restrictions. Donations without donor restrictions are those where the donor does not impose any conditions on the use of the funds. These funds can be used by the not-for-profit entity at its discretion for any purpose that supports its mission. This includes general operational support, as in option D. So as you can see here, it's pretty straightforward when you kind of read what each thing is used for. With donor restrictions means that the donor wants it to be used for something specific. Without donor restrictions, it's just money that's given to the organization to use at their discretion. That's the easiest way to think about it. We're going to dive into some different things that might affect that or might go into each of these categories. So let's go to the next question. Alright, here we are at question 2. A donor provides a $750,000 note to a not-for-profit entity with the stipulation that the principal amount must be maintained in perpetuity, and only the earnings from this donation can be used to fund scholarships for underprivileged students. What is this type of donation called, and where should this be categorized in the net assets section of the statement of financial position? So, part of this, pretty easy to figure out, I would say. The fact that it's supposed to be maintained in a specific way and used for a specific purpose, you can probably figure out that it's with donor restrictions. But what is this called? What is it called when they give money, it's supposed to be invested, and then they're supposed to use the earnings for something specific as well? If you don't really know, that's okay. We're going to dive straight into the answer for this one as well. Alright, the answer is D. It's called a permanent endowment, and it's categorized, like you guessed, as with donor restrictions. So let's talk about this. This type of donation is known as a permanent endowment. A permanent endowment requires that the principal amount be preserved indefinitely, meaning the organization cannot spend the original $750,000. Instead, only the earnings generated from investing the principal can be used, and typically these earnings are also restricted for specific purposes, such as funding scholarships, as in this example. In the statement of financial position, permanent endowments are categorized under net assets with donor restrictions. That makes sense. This is because the donor has imposed a restriction on the use of the principal amount, which must be maintained in the perpetuity. The specific use of the earnings further confirms the restriction. So this is another type of donation that has donor restrictions. It's basically, the idea is they give a whole bunch of money. They're supposed to maintain that money and use any earnings from it, a lot of times for a specific purpose. But that's all restricted, so this is something that's going to be with donor restrictions in the net assets. Again, it's called a permanent endowment, and now let's go to the next question. All right, here we are at question 3. During the fiscal year, a not-for-profit entity received the following contributions. They received a $100,000 unconditional promise from a donor to give this amount over the next 2 years to support the entity's primary purpose. They also received a $50,000 unconditional cash donation from another donor intended for general operational support. How should these contributions be categorized in the net assets section of the statement of financial position? Okay, so one of them is a promise, one of them is an actual donation, and then there's that word unconditional. What does that make you think of? Now, you might have an idea based off what we just read, and if you want, go ahead and pause the video to kind of think through this. If not, let's go to the answer. All right, the answer is A. The $100,000 unconditional promise should be categorized as with donor restrictions, and the $50,000 cash donation should be categorized as without donor restrictions. So that $50,000 one probably made sense, but the $100,000 one might have been a little bit confusing, so let's walk through this. First, let's talk about the unconditional promise to donate. When a donor makes an unconditional promise to donate funds in the future, this is typically categorized as with donor restrictions until the funds are actually received. The reason is that although the promise is unconditional, the funds are not yet available for use. The restriction is based on the timing of the donation, as the entity cannot use the funds until they are collected. So basically, just to reiterate that, even though they've received a promise, they know they're going to get the money, and they know that the money can be used for whatever they want to use it for, because they haven't actually received that money yet in their statement of financial position, they have to basically restrict that money right now because they don't want to use $100,000 that they haven't even received yet. So that's $100,000 that's going to be included in with donor restrictions until they actually receive the cash, and then if it's still an unrestricted or unconditional amount, they can move it over to without donor restrictions. As far as the unconditional cash donation, it's pretty straightforward. This is received with no restrictions. It can be categorized in the without donor restrictions, and it can be used for whatever they want. It's going to be used for any purpose that supports its mission. So again, the unconditional promise is going to be with donor restrictions until they actually receive that money, and the donation that's an unconditional cash donation is going to be just without donor restrictions. Let's go to the next question. All right, here we are at question 4. A donor provides a $500,000 contribution to a not-for-profit entity to fund the renovation of an existing community center. The contribution is conditional upon the not-for-profit entity securing the necessary permits from the local government within the next 18 months. The cash has already been received, but the permits have not yet been secured by the end of the fiscal year. How should this contribution be reported on the statement of financial position? Okay, so this is a little bit different. They've received the $500,000, but it is conditional. So we were talking about unconditional in the previous one. We're talking about conditional in this. So what does that mean? How is that going to be recorded if they haven't actually met the condition yet, but they have received the money? So think about this, come back when you're ready, and we'll look at it together. All right, here we are at the answer. The answer is C. The $500,000 should be reported as a liability on the statement of financial position until the condition is met. Now, this might sound really weird because you're like, this is a donation. I don't think I should be recording it in a liability. But let's walk through this and you'll kind of see where it's coming from. When a donor makes a contribution that is conditional, even if the cash is received, the not-for-profit entity cannot recognize the amount as revenue until the condition is met. In this case, the $500,000 contribution is contingent upon securing the necessary permits from the local government. Until this condition is satisfied, the not-for-profit entity does not have an unconditional right to the funds. So they have to report it as a liability. Since the condition has not yet been met, the $500,000 is recorded as a liability on the statement of financial position. This is because the entity may have to return the funds if the condition is not fulfilled. So you thought that normal accounting is conservative? Well, not-for-profit accounting is even more conservative. They look at this money and say, there's a risk that we're going to have to return this money if we don't meet the condition. So until we've met the condition, this is going to be recorded as a liability because we may have to give this money back. So that's why they're recording it as a liability, because they've already received the cash, but they haven't met the condition for keeping the cash. So they're going to record it as a liability until they have met the condition. It's not recognized as revenue. Once the condition is satisfied, the liability is removed and the amount is recognized as revenue. So once it's satisfied, if they meet it in the amount of time that they're supposed to, then they can move it to revenue. typically under net assets with donor restrictions if there are further restrictions on the use of the funds. In summary, conditional contributions that have been received but have unfulfilled conditions are recorded as liabilities until the conditions are met. And then this is one thing that I want to point out here. We're not going to go over it in another question, so I want to make sure you pay attention to this. If it is a conditional promise, meaning no money will be received until the condition is met, nothing is recorded. Because again, you haven't received any money and you haven't met the condition to get that money, so you can't record anything until you've met the condition, because once you meet the condition, then you'll actually get the money. But if it's a conditional pledge, as in they received the money and they can keep the money as long as they meet the condition, that's where you record it as a liability. But if it was a conditional promise where they're like, if you do this thing, then we'll give you the money, then you don't record anything until you've actually met the condition and you've received the money. Okay, let's go to the next question. Okay, here we are at question 5. A not-for-profit entity received 2 significant donations during the fiscal year. A $300,000 donation restricted by the donor for the renovation of a local community library, and a $100,000 donation that was initially restricted by the donor for use in a youth outreach program. Later in the year, the donor removed this restriction, allowing the funds to be used for any purpose. During the year, the entity incurred $200,000 in expenses directly related to the library renovation. How should the entity account for these transactions on the statement of financial position? So this is a little bit different than what we've seen before. These are things where they had restrictions, but later in the year, they might have been removed, or something happened that also might have changed it. We're not sure. So read through these different options. Think about it. Think about what makes sense if $200,000 of expenses related to the library were used, and come back when you're ready and we'll look at the answer together. Okay, here we are at the answer, and the answer is B. The $200,000 used for the renovation should be reclassified from net assets with donor restrictions to net assets without donor restrictions, and the $100,000 for the youth outreach program should be reclassified to net assets without donor restrictions. So the remaining $100,000 for the library should stay in net assets with donor restrictions. So let's walk through this. They have 2 separate donations. The library donation of $300,000, it's restricted, and the $100,000 that is also restricted. During the year, $200,000 was spent on the renovation, fulfilling part of the donor's restriction. So part of the restriction was that it has to be used for the library. So they used $200,000 specifically for the library, so they can move or reclassify $200,000 of net assets with donor restrictions to net assets without donor restrictions because it's been used for that purpose. However, there's still $100,000 that is left, and they haven't met $100,000 of expenses for that. So that's going to stay in with donor restrictions. Then you go to the youth outreach program. Initially it was restricted, but they chose to release it. It's no longer restricted. The donor wants it to be reclassified to without donor restrictions. So these are a couple different ways where things can be reclassified from with to without donor restrictions if the purpose is met or if the donor chooses for it to be changed. Those are some reasons that something can be changed from with to without donor restrictions. Okay, let's go to the next question. All right, here we are at question 6. A not-for-profit entity has the following assets as of the end of the fiscal year. They have $90,000 in cash, of which $30,000 is restricted for the purchase of a new building to be acquired in 18 months, and $10,000 is restricted for operating expenses to be incurred next month. $40,000 in accounts receivable expected to be collected within the next 6 months. $20,000 in prepaid insurance, with $10,000 to be used in the next 12 months and $10,000 to be used in the following year. $200,000 in land held for future expansion, and $150,000 in equipment net of depreciation. What is the total amount of current assets that should be reported on the statement of financial position? Okay, this is the only question where we're dealing with something other than net assets and equity, although I guess we dealt with liabilities in the conditional question. But here we're dealing with current assets in the statement of financial position. So your current knowledge of current assets is probably sufficient to figure out this question. Go ahead and read through this, think through the information that's given, and when you're ready, come back, we'll look at the answer together and see if you got the right answer. All right, the answer is B, $110,000. So let's walk through this. In the statement of financial position, current assets are those expected to be converted to cash, sold, or consumed within 1 year or within the entity's operating cycle, whichever is longer. Now, you know this. This is very similar to the balance sheet of a for-profit company. For the cash, there is $90,000 of cash, and normally cash would be current. But let's look at this. There's $30,000 that's restricted for the building purchase that's in 18 months, that's non-current. And there's $10,000 that's restricted for operating expenses next month. But wait, that's current because that's next month. So the current portion of cash is the $60,000 which is the $50,000 that's not restricted by anything, and then the $10,000 that's restricted, but it's specifically for near-term operating expenses. So $60,000 of current cash, because there's $30,000 they are setting aside specifically for a building that they're building in more than a year. Then there's the accounts receivable. That's expected to be received within 6 months. Prepaid insurance, out of the $20,000, $10,000 is going to be used up in the next 12 months. So it makes sense why only $10,000 is going to be current. And then there's non-current assets, which is the land and the equipment. That's not going to be included. So total, you include the $60,000 of cash that's current, the $40,000 of accounts receivable that's going to be received in 6 months, and the $10,000 of prepaid insurance that's also going to be used up within the next year. So pretty straightforward. It's very similar to a balance sheet for a for-profit company. That's what the statement of financial position is. It's essentially the balance sheet for a not-for-profit company. So this was one question to kind of just remind you that we're not just dealing with net assets, with donor restrictions or without donor restrictions when it comes to the statement of financial position. We're still dealing with assets and liabilities, but the most complicated part of it is the net assets. So that's why we've gone over that mostly in this video. And we've learned a lot in just 6 questions. So before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics is, as you're going through the questions to learn the material, you will notice the things that keep popping up, the things that you keep noticing. Oh, they're teaching me what goes into net assets with donor restrictions, or they're teaching me what goes into net assets without donor restrictions, or they've shown me 3 questions that where there's a conditional amount of money that was given, and so it's recorded as a liability. These different things that keep popping up throughout the questions, you take note of those, and you write them down as pillar topics, kind of to summarize the most important topics from what you were studying so that you know them for later. So let's go to the pillar topics for this video. All right, here we are at the pillar topics. Now let's just dive straight in. First off, donations are classified as either with or without donor restrictions based on any donor-imposed conditions or purposes. Conditional promises to give are not recognized as revenue or liabilities on the statement of financial position until the conditions are met. However, if cash is received, so this would be like a conditional donation or contribution, but conditions remain unmet, it is recorded as a liability. So when there's a condition, if you haven't received the money yet, you don't record it. But if you have received money, but there's still a condition that's been unmet, then you record it as a liability because you might have to give that money back. Next, permanent endowments. A permanent endowment involves a donor-imposed restriction that the principal amount be maintained in perpetuity, and only the investment income can be used for a specified purpose, categorized as net assets with donor restrictions. Usually the earnings are also with donor restrictions, although sometimes they can be used for whatever. Now, when it comes to reclassification of net assets, when donor-imposed restrictions are satisfied, such as spending restricted funds for their intended purpose, the corresponding amount should be reclassified from net assets with donor restrictions to net assets without donor restrictions. This can also be changed if the donor chooses to remove the restriction. So those are some of the cases where things can be moved from with to without donor restriction. And then finally, unconditional promises to give are typically classified as net assets with donor restrictions until the funds are received, as they represent future resources that are not yet available for use. So if somebody promises you they're going to give you money and they promise it without a condition, you don't have to do anything to receive the money, they're just going to give it to you eventually, you still have to record it as with donor restriction until you receive it, because you can't use money you haven't actually received yet. And with that, those are the pillar topics for this video, kind of a summary of what we learned from this video. And that is the end of the video. Before you go, make sure you check out our free 1-hour webinar training on superfastcpa.com. The link is in the description of this video. And again, it is only 1 hour, it is free, and we will teach you how to pass the CPA exam without wasting any time. Also, just a reminder, we only went over 6 questions in this video, but Superfast CPA members will have access to the full 12-question video when we post it in the members forum, so if you like this, you can get more of it by becoming a Superfast CPA member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.